Hi, I'm Caroline Woolley of Meaden and More, London. This is the video interview series, the next instalment. I'm actually here in the office, although the person I'm interviewing isn't in the city today, so we're still on Zoom. This video interview series is business interruption and other stories. Recently, I've done a few DE&I related, so definitely more other stories. This is bringing us back into insurance, but looking specifically at captives. I'm going to be interviewing David Hully, who is now at Risk, which is a consulting firm. It's captive consultants. Risk and insurance strategy consultants is what Risk actually stands for. I first met David when he was at Allianz, and he was market and global account manager. But he's always had a special interest in alternative risk transfer, ART, and captives. So his experience spans from sort of equity investment research to D&O underwriting, but he's sort of gone into a specialist area in terms of ART and captives with Risk. So I will admit David, and he will join us, and he will join us shortly, and we're just going to explore captives a bit more and look at some advantages and disadvantages. So, and here he is. Hi, David. Thank you very much for joining me today, virtually.
Hello, Caroline.
Hi. I've just done a very brief introduction to you and when we first met, when you were at Allianz, and I was talking about your special interest in ART and captives, but I know you've got a couple of non-executive director roles as well, but you're working with Risk, the consultants, with other sort of senior risk professionals, but also some old friends who I know we spoke with Veronique recently. So I don't know if you want to do a quick intro to what you're doing, and then we'll go into the some questions that we have.
Yes, so thank you for having me. I'm doing quite a bit in the captive space in general. So there's Risks, which is the independent captive consulting company, and we're doing a lot of work with advising large corporates, but also other players who use captives to either set them up or review their current structure or advise them on their reinsurance structures. So that's where the alternative risk transfer side comes in for structured reinsurance solutions, and also other esoteric things. And so we work with corporate clients, we work with regulators, we work with certain brokers, and these things tend to have fairly positive outcomes. In addition to that, as you mentioned, I'm an independent director with Adele Technologies, which is an early stage startup in the insurtech space, and that's for the administration of international insurance programs, often for either captives or very large corporates. And we hope that's going to be a game changer in terms of bringing in efficiency and visibility for basically the practical aspects of running large programs. In addition to that, I've also have some other independent directorships that I'm either starting or currently doing, and most of that's also in the sort of like captive space.
Well, yeah, they seem to go hand in hand in terms of what you're doing with Risk as well. So that's very good. But there seems to be more and more, but clearly keeping you busy. But I mean, hopefully I'll see you in London soon. But of course, you're not in London now, are you?
No, I'm in the Channel Islands in Jersey. I moved here recently for family reasons, and that's using to my advantage basically to do a lot of work with captives and the proximity to Guernsey and a lot of other service providers.
Well, maybe I'll have to, if we do more captive work from a Meaden and More perspective, maybe I might find myself coming over to Guernsey, hopefully soon. We work with, from a claims perspective, both, but also post-loss, but also pre-loss, working with captives. So yeah, hopefully we'll get an opportunity to work together at some stage soon. But I just wanted to focus on a few areas. We're talking about captives and the captive market, and it's a bit of a sort of update on what's going on, but exploring a few things in relation to business interruption. So as you know, the video interview series is business interruption and other stories. But first of all, there's so much happening in the world of risk and insurance at the moment. As we know, from hardened market to supply chain restrictions and issues, from inflation to war in Ukraine. So there's an awful lot going on, but how is this affecting the captive market in particular, would you say?
Well, we're seeing a huge growth in captives, both from the new captives that are being formed and also the expansion of existing captives. So a lot of that started with the hardening market a couple of years ago. There were multiple sectors where people either couldn't find capacity at all and were going down the route of forming a captive so they could stay in business. Others who saw the rising prices and have a dynamic captive strategy, which is to increase the amount of capacity that they use in their captive to balance out the costs. And then we also have, something that's just been building over time, which I think we'll discuss later, which is putting non-traditional covers through captives. So that's been on the grow as well in general.
And I know that we've seen a part of it is obviously the hardening market and capacity availability, but a big increase in deductible levels as well, and which I assume affects I know I've dealt with a few where there's a certain amount in captive which covers the big deductible before the external market comes in. But the captive market, I suppose, is the same as the insurance market, that they'll be seeing the same issues and the same impacts.
Yeah, in many ways. But if a large corporate is seeing an increase in their deductible, then they can either buy deductible infill policy, or they can just take that increase in deductibles directly into their captive, which in many ways meets one of their requirements, which is the difference between what, say, a local business unit in a country can take on their local P&L versus what the corporate can take on the P&L. So, if that deductible is being pushed onto the global program, then they can just say, look, local business partner, you stay where you are. We're going to make up the difference in the captive. And that's quite a powerful shared service that a captive can provide to a large corporate.
And I know that, your experience is broad across ART generally, and obviously looking at captives, but I suppose people sort of sometimes are quite blinkered in looking at a solution, but actually they can have such a combination of different ones. I know you're fresh from the captives, the European Captives Forum, aren't you? So you went across for that. And I was at a conference just yesterday talking to a chap on parametric, and parametric has come very far since I was first talking to them on non-damage business interruption risk. But it's a combination of all of these that can actually end up with a good solution, and you're perfectly placed to look at all of these.
Yeah, so yeah, just there's a lot of themes there. One of those being parametric. So that's something that's been around for a long time, especially if you consider weather insurance, but it's moving from what was once perhaps niche or multiple niche solutions that were focused on the likes of power utility companies or water utility companies, which are now being generalized to a very broad set of perils that are becoming much more relevant because of climate change.
Yes.
And, captives and parametrics are a great way to manage that risk inside of a captive for the benefit of business units, like we discussed in a similar way for deductible management.
Yeah. Well, sort of drawing it, looking at there's a combination of all these solutions, but looking at business interruption risk, the more traditional property damage business interruption risk isn't necessarily commonly put into captive, but I know that previous discussions have been looking at emerging business interruption risks, or emerged ones like non-damage business interruption. These can be taken into a captive, and I know that we've talked previously about incubating a risk within the captive to learn about it and gather data before going out to the external market. But have you seen this often in action, the business interruption emerging risks in the captive?
Yes, so there's been a crescendo of this over the last handful of years, maybe even going back 10 years, where you'd have industry-specific business interruptions like regulatory shutdown in the large life sciences companies. You would have, weather risk effectively is treating a non-damage business interruption that is, you don't have any damage at your facility, but because of a weather event, you can't operate. And so that was an indirect way of doing things. Many of the things that could be of interest, from our past conversations, is coming up with something that's a bit more specific to a client's business interruption requirements. So you don't have something like the basis risks that you get with a weather policy, where you could actually not have a loss, but even if the weather event happens, and so something like that could be windstorm, where you think, if a windstorm comes through, I might not be able to operate my business, but then the windstorm happens and your clever employees find a way to continue operating and there's no business interruption, or vice versa. There's the parametric, such as cat in the box, where a policy would pay out if a storm goes through a specific box of latitude and longitude, then it pays out. But it just didn't work out exactly as you would want, and you have the loss, but the parametric didn't pay out. And so there's that basis risk, which is quite frustrating sometimes with parametrics. But if you can get it right and you can get the alignment, then it's really good.
So when we're talking about using the captive to incubate risk and gather data, and I know that we were looking at supply chain risk particularly, as there's the capacity in the external market was getting, maybe not reducing, but definitely getting tighter, and more data being required, and looking at direct suppliers only, first tier, strictly looking at first tier. So when we're looking at these sort of emerging risks, it's one thing where they might be partly insured with the external market, but would you use the captive for any risk, that's either not currently insured or even uninsurable? And, the fact is, with any risk, and if it's actually manifesting itself in actual losses, then companies are taking this on the chin anyway. It's sort of hidden in operational cost, and they're suffering these losses. So, if you're suffering them anyway, isn't it worth separately identifying, gathering the information, if that all sounds very good, but we've got to think about the downsides and the, from the captive still has to follow the rules in terms of capital requirements. So it's just exploring the upside and the downside of using the captive for those sort of risks.
So, as you say, a captive has to demonstrate that the parent or whoever they're insuring has an insurable interest in covering something. And you have to be able to provide the data to satisfy whoever it might be, the regulator, the tax authority, various other people, that you're doing something that's prudent and appropriate. So there's that. So you can collect your own data and build something up. And then if the captive is in turn insuring overseas subsidiaries, then it all has to be done on a pricing basis where the transfer pricing is appropriate. So it can become quite a complicated and technical approach, especially if it's a novel type of coverage. On the flip side, you can have certain things like, say, pandemic coverage, which after the last handful of years, there's lots of data about, but you find that like getting the reinsurance for it can be extraordinarily difficult. And so it comes very much down to the client's rationale for putting it into a captive. If it's to spread the risk along its business units around the world, and they want to say, okay, well, if we have another COVID situation, well, this isn't going to help. But if we have a situation more like, say, SARS or some of the other pandemics which we had in the past, and it's potentially only going to affect one country, but you don't know which country it's going to affect, then you can pool that risk amongst your business units and ensure the P&L of that one business unit. And then when the limit's exhausted, it's exhausted. And that also works quite well with climate change solutions, where you're finding that there's more and more volatility around the world. And, that could be for what they call the demand side. It's a climate event puts your clients off of buying your product, or it could be a supply side, such as not enough rainfall. So there's not enough hydroelectric power, so you can't run your facility. So it's a supply chain non-damage business interruption issue, or they're both non-damage business interruption, really. And you can say, well, okay, well, there's lots of data for weather, and you can build a model and you can get that reinsured. And then there's also alternative risk transfer cross-class programs. So in effect, you might find that there's no traditional product available, and you can't get it normally reinsured on a single peril basis. But if you have a stop loss, that would require other perils to be triggered first before a non-damage business interruption is triggered, then you can find various different ART underwriting teams who will take a view that it's a third trigger event, and they can model the first two triggers, and the third trigger they can take a view on.
Yeah.
And you get capacity that way.
And I know that sometimes the wording can be, particularly with the emerging risks and where it's not insured in the external market, getting the wording sorted can sometimes be difficult. But from a business interruption point of view, I always try and talk about business interruption as insureds would, because they sort of see it as anything that can interrupt business along the lines that you've been talking today. Whereas people in the insurance industry tend to be a bit blinkered towards property damage business interruption, because that's the traditional policy that everyone buys. That's changing, of course, with cyber and the increasing capacities within cyber. But from BI point of view and looking at claims, you know, the captive still has to go through the claims process, and that's where we would work with the captive. But business interruption, you're really talking about, you know, how severely you're interrupted and for how long. They're your two main variables. And the impact on the business is going to be the same. You know, obviously those variables are different, but the impact on the business is the same, whatever the event. You know, you're interrupting the business. So we can still, from a claims perspective, do the business interruption calculations, but it's just a bit more difficult when you move away from, you know, if a whole factory's burnt down, it's pretty obvious, you know, when you can see the impact very clearly on production levels if it's a manufacturing firm. But when you move away from that, it can be more difficult to decipher, you know, what's actually caused that interruption. And there's other things going on, but we can still do it. So yeah, all these other risks, the principles still apply. The business interruption principles still apply. And from our point of view, you know, we do say don't wait until after a loss to look at the risk and understand the exposures, whatever's caused it. Go, you know, let's do it up front. And that does work particularly well, I think, with captives, because there is a real interest of making sure that the insurance is right, but actually looking at the risk and the resilience part, I think there's even more incentive to do things up front.
Yeah, I think you definitely need to have that. I think whether you go to Guernsey, Luxembourg, or any of the big captive domiciles, you need to justify why you have this in your captive. You know,
yes,
does it classify as an insurance? You know, what's your indemnifiable risk? Otherwise, you're going to go back to where we were with the IMF and OECD review with the basis erosion and profit shifting, ideas that people are trying to avoid tax or these other considerations. And it's kind of like, well, okay, we can all sort of sit here and say like, well, you know, we're doing this for all the best reasons, but it needs to be documented. It needs to be able to stand up to scrutiny. Not only today, when we're all the people who come up with it are sitting there and can explain it, but like 5 years down the line, when, you know, somebody gets an audit, right, or somebody, you know, somebody gets queried by a tax authority.
And that's, you know, I tend to have my head in sort of insurance and risk, but actually financially the captive can of course make sense. Traditionally it has been looking at how it fits in with the business and profitability and tax purposes. So yeah, it does all help. But listen, I've promised the marketing team to keep these relatively short, but it's been lovely to speak to you today. And I know that our conversations are definitely going to continue. And yeah, as I said, hopefully we'll be able to work on some of these captive projects with you, because as you know, I'm an accountant. I always come back to the numbers, but you know, just as a basic, it's how do you know if it's the right decision from an insurance wise if you haven't quantified your exposures. So that's where we come in. But yeah, hopefully we'll have an opportunity to work together again soon. And thank you very much for your time today. And good luck with all your various projects and obviously with the team at risk.
Well, thank you very much. It's been a pleasure. Looking forward to speaking soon.
Yes, I'll see you either in London or Jersey or Guernsey. Let's see.
Speak soon.
Thanks, David.